Yeah, good afternoon, MarketChameleon.com. I'm Adam. That's Dmitry. What's up, Dmitry?
Hey Adam, how's it going?
Going great. Everybody, remember if you're on following us on YouTube right now, you can click that subscribe button, follow the link, and subscribe to us on YouTube. Everybody who's joining us on MarketChameleon.com, you guys are in for a treat today. We're going to building our. This is lesson number 2 of our trading model building seminar. What do you think about that, Dimitri?
Hey,
I just came up with
that's awesome.
that.
That's awesome. I love
Why don't you go ahead
it.
and share your screen, Dimitri? I'm going to give the
Okay.
disclaimer here right now. Everybody remember, option trading is risky. We are just giving you ideas. We are not telling you what to trade. You got to do that on your own. That is what the chameleon is for. Is that right, Dimitri? Is that right? The
That,
chameleon is rocking today, I hear.
that's right. Can you see
Yeah, I
in my
see your
share?
screen, but yep, absolutely. Just take that away.
Okay.
No, yeah, just take that away and we're good to go. Yep, we got you, man.
Okay. Awesome. So today I wanted to talk about option Greeks. We got a lot of emails requesting an explanation for the delta, gamma, theta, vega, rho, and that's what and how to manage the risk and manage your options risk around them.
Yep.
So we'll go into that, and before we get into the individual ones, I just kind of wanted to explain what this means, the option Greeks, and essentially those Greeks help us. Help us assess and manage different risks associated with options. And when you think about it, and I try to draw an analogy, uh, like an airplane pilot, right? When he's flying, he has all these different tools letting him know what types of risks he has. Low fuel, uh, cabin pressure, whatever it is.
Right.
He's always monitoring it, and it keeps him. It allows him to safely get to where he needs to go.
Gotcha.
That's kind of what the option Greeks are. It tells you what types of risks you have, and we have different types of risks, and this way you could kind of assess them and monitor them and even hedge them off.
Cool.
Another thing I know, I've seen some videos and people talking about it, like delta, and how exact are these things, and the Greeks themselves, they're taken out of the options pricing model. And these are theoretical risk metrics. And what I mean, it's estimates, right?
Right.
Because in options, it's statistics. So nothing is exact. When you flip a coin, right? Like if heads or tails, then exactly there are two outcomes, two possible outcomes. Either heads is going to come out or tails is going to come out. So it's 50-50.
Right.
When you look at a stock or any option pricing, you say, well, where's this SPY going to be in a week? We can't say for sure it's either going to be 270 or 280. It could be any range of numbers,
Sure.
right? It could land anywhere. So the outcomes are not discrete. We don't know exactly, when you flip a dice, 1, 2, 3, 4, 5, 6.
Mm-hmm.
We don't know where SPY. It's a range of possibilities.
Yep.
And we kind of can tell, is it going to be at zero? Probably, that's probably a zero chance of that happening. Will be down 50% in a week. There's probably a zero chance of that happening. Mm-hmm. But as you get closer, will it be down $1 or $2? There are probabilities of that happening. And essentially, there's an infinite number. So you get an estimate, right?
Sure.
These models, they're trying to get an estimate and using ranges of possibilities. So when you look at a delta or a Vega or theta, you're getting a close estimate to help you manage your risk.
Yep.
And these inputs, they're dynamic. So when we look at it, we just kind of take a snapshot in time and say, what is our risk? But they could change. The stocks are moving around, implied volatility.
Yep.
They're changing moment to moment, even maybe a little bit, but you're getting an idea, an estimate of what your risks are.
Yep.
Now, moving on. So we'll go to the first Greek is delta. And the delta it's telling us what the option value is expected to change with a $1 move in a stock price up or down. And we call it our directional risk.
Right.
Looking at SPY over here, and I'll just take like maybe this 1 month, and let's just take like an at the money call, right? And we see this delta is 52.
Mm-hmm.
Essentially, what that's saying is if this stock price goes up, by $1, then we expect this option to increase by 52 cents. If the stock price goes down by $1,
right,
then we expect the option price to decrease by 52 cents. And 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 each option represents 100 shares at expiration, right? So that would be like 52 shares. 10 options represents 1,000 shares at expiration if you exercise it. So it would be like 520. Your risk is $520 right
gotcha.
now, 52% of that. And just to take a look at it, we'll just create this risk over here, and let's just give it 10 options, right? Let's say we bought 10 options, and right here we see that our delta risk right now is 522.
Mm-hmm.
It's around this number, and that means, well, if the stock goes up $1, we're expected to make $522. If the stock goes down $1, we're expected to lose $522. Gotcha. And if we want to hedge that risk, and for our purposes, we're professional traders. We don't want to take the directional risk. We don't know. We're going to trade the option for a different purpose, and we want to hedge that risk. So what you would do is we could short 500 shares of stock, right? So let's sell 500 shares. Oops, sorry. So we're going to sell that 500 shares. So if the stock goes up $1, we're going to make $500 on the call option, and we'll lose it on the stock.
Gotcha.
If it goes down, it's the opposite. We'll lose it on the option, make it back on the stock. And when I run this, you're going to see that our risk graph, this is what the call looks like, right? But now that I'm hedging it, this risk graph is now going to start looking more like a straddle in here. So see, now our delta risk has gone down. You know, it's less than 122, and this is how now it looks like a straddle. So even on the way down, even though we have a call, we hedged it with short 500 shares. So on the way down, we'll start making money over here. And that's how you would just say, I'm delta neutral for the next dollar move, right?
Gotcha. Yep.
After it moves, then what happens is our delta will increase or decrease, and we'll have to start re-hedging. So at this point, we're basically delta neutral. And let's get then to the next Greek. So this next Greek, it's gonna be the gamma, okay? And the gamma, it's what you're expecting the delta to change by with a dollar move in the stock. So we're delta neutral right now. If the stock increases by $1, our delta is expected to increase by a certain amount in this situation because we're long a call. Or if it goes down $1, our delta is expected to decrease by a certain amount. We'll be short. And when you look at gamma, usually gamma and theta, they're used in conjunction. So you have to look at both of them, and I'll explain that in a little bit. And what you're doing here, what type of strategy you're doing now, we're not looking at a directional risk anymore, but if we're going to trade our gamma, the strategy is we're going to trade the realized volatility, the volatility of the stock, versus the implied volatility of the option. It's called delta re-hedging. I'll show you how that works.
Yeah, show me that, because that I don't really get.
Right. So the idea now is what we're looking at is we want to trade volatility, not the delta, not direction, but the volatility and the movement of the stock. Gotcha. So in this example, I'm gonna just increase the gamma. I'm gonna just put we have 50 options, okay? So we bought 50 of these options. You could see now our gamma increased. Of course, our delta increased. So I'm gonna sell this extra 2,100 shares. So it's 2,600. We're back to delta neutral. So right now our delta is close to 0. We have 500 gamma, and per day our options are expected to decay $925.
Gotcha.
If nothing happens, we're going to lose $925.
Right.
We need to trade the volatility of the stock, and what is happening now is we're looking at this implied volatility, and based on this, we're saying that the average daily volatility, because we own the option, we want the average daily volatility to be higher than what the implied average daily volatility is in the option. Okay, we're trading the option implied volatility versus the actual volatility of the stock. And I'll give you an example. Like, here's 500 gamma, right? If the stock goes up $1, right? What this is saying is if SPY goes up $1 from here, our delta will increase by 500. In that case, what we do is we short 500 shares to get back to delta neutral.
Gotcha.
Does that make sense?
Yep.
Right. So it increased from 274, say 50 to 275.50. We sold short 500 shares to get back to delta neutral. Now let's assume the stock comes right back down to the same spot, goes back down $1. Right. Well, because we're delta neutral, now we're short 500 deltas because it went back, it's down $1. We have to buy that 500 shares back. Does that make sense?
Yep.
So essentially what we did was we flipped 500 shares of stock for $1. That created a $500 profit.
Right.
Right. Because we're back to the same position as original, but what we did was we sold 500 shares and bought it back. We flipped it for $1. We made $500 in trading the stock, trading the volatility.
Right.
However, this wasn't enough, right? Because we needed to make up $925.
Right.
So in this situation, it would have been actually better to be short the option and negative hedge your delta, right? So we would have lost $500, but we'd have gained $900 in decay.
Gotcha.
And that's what it. So you're trading the realized volatility versus the implied volatility, because now you have to make up in realized volatility what you're expected to lose today in the decay. And that's trading the daily volatility, the realized volatility of the stock, right? The actual volatility of the stock versus the implied volatility in the option. And you're hoping that if it's very volatile, right? If it's very volatile and you got to flip that 3 times in one day, then you would have been profitable, right? If we're able to do that 3 times in one day. And there's different variations. It doesn't have to just go back and forth, land in the same spot, because as it's moving, your position is gaining or losing. But that's essentially what you're trying to do, is trade the volatility, the stock volatility versus the implied. Is that okay? Makes sense?
Yep.
Okay.
I trade vol, baby. That's how we got the Twitter account, right? We're talking about if you are interested and follow us on Twitter, I trade vol. That's Will's account. If you want to follow him on Twitter, and he's been doing a lot of little videos every day, giving us hits on what's going on in the market. So I trade vol at Twitter.
Awesome. Then we talked about the decay. The decay is what you're expected, the time value of the options expected to lose on the day.
Yep.
And so we go then to the next Greek is Vega. And the Vega, that's the expected change in the option value for change in the implied volatility. Now let's take a look at an example here. Right here, this is telling us we are long positive 595 Vega.
Mm-hmm.
And what that means is if implied volatility, right, if the implied volatility moves up 1 vol click, right, like if it's 12.6, it goes to 13.6, then our position is expected to make $595.
Mm-hmm.
If it moves down 1 vol click, it's the other way. We're going to lose $595.
Right.
Right. And let's take a look at maybe, let's see if I could. Oh, we only have a few days left here. Let me go out a little bit further. Well, let's try this. So over here, you see that on March 11th, right?
Mm-hmm.
I'm just looking at what our P&L would be on March 11th. And you could see that at the end of the day, we would lose because it would decay. Right. So the option would decay, and it would have been a net loss by the end of the day. There's like about a day and a half decay. So and by the way, this decay, it also increases as you're getting closer to expiration. Like we said, these are all dynamic, right? So the at time when you change any variable, the implied volatility, time, days to expiration, the stock moves, all these start changing as well. But you could see here that this position would lose money because it would just decay at the same time, at the same price. So let's pretend that the volatility though went up, and let's increase the volatility from 12.7. Let's just say it goes up to 15. Mm-hmm. Right? So it goes up to 15, and let's see what happens on March 11th. So because it went up, you see here, we didn't lose as much. Yep. It actually, it didn't decay as much as expected because the implied volatility started to increase. And if we increase it a little bit more, let's go to 18. So now we're making money. Yep. So even though the stock didn't move, everything is at the same spot, but if implied volatility went up, the option actually didn't decay because the premium just increased. That's how the Vega would work. Obviously, it would go the other way if if it could decay and volatility could decrease. So then you would have even a bigger loss. If it went down to 14. Let's look at March 11th. So the loss would be a little bit steeper.
Sure.
Right. And that's your Vega position. To hedge off your Vega, really, all you could do is sell more options, right? You'd have to sell something. You'd have to sell volatility.
Right.
So to get this down, same thing as gamma. If you think, whoa, I have too much gamma, this is too much decay. There's no way I could trade the stock and make that much. That's not reasonable. I have to reduce my risk maybe, or go the other way. But the way to do it is you sell an option. And I'm just going to sell any option. Let's just say I sold this put, right? So I sell this put. I have 50 of these. Let's sell 50. All right. So the aim here is to reduce our gamma and reduce our Vega risk by selling an option.
Right.
So that's what we did. You see, we reduced our Vega risk, we reduced our gamma risk, but now we have a delta. Because I sold these puts, it's going to look like this. So in this situation, I have to sell another 1,700 shares on top of this. All right. So what is that, like 4,300? Now I'm back to delta neutral, gamma, and now just reduced all my risks.
Gotcha.
Okay, and that's how you would start managing your position. And this is, remember, dollar for dollar, whatever. These start moving around. All right, these start moving around depending where the stock starts going, and then you're just managing that risk as you go along.
Gotcha.
The last one is row. I think that we have. Let's go. Yeah, and I don't have anything after that. So the row, it's the expected change in the option value for change in interest rates. In here, our row is positive $136. If interest rates go up 1%, then our overall position is going to make $136, expected to make $136. If interest rates go down, it's expected to lose $136. And the reason is for that because, we bought a call and we sold these puts. So how do we make this? Well, the Black-Scholes model takes into consideration that you're hedging.
Right.
Right. So in our situation where we sold 4,300 shares of SPY, right? So if you sold short 430,000, just imagine, that each thousand is $274,000 worth of stock, right? If you sold 4,300 shares, sold short 4,300 shares of stock, well, that means that you had cash that came in, right? Because you borrowed the stock and you sold it short. That means you received cash. It's sitting as collateral in your account, right, earning interest. So since the cash earns interest, if interest rates go up, you would earn more interest, right? If interest rates go down, you earn less interest, and that's what your row risk is. Um, that's calculated. And
Boy, it makes
those,
me feel like I wish I hadn't dropped that stats class in university.
and you don't really need to even know the, most people don't even know the stats behind it. They
Of
just
course
use
not.
it
No, they
because
just
these
look
are,
at that number right there. Yep,
yeah, you're just looking at
absolutely.
that number and saying, where's my risk? What do I want this risk?
Yep.
Maybe we sold these, but really maybe you want the risk because you think, well, this implied volatility is way undervalued, and that's what I want.
Mm-hmm.
I don't care about, I don't want the delta risk. So, I'm going to buy back the delta. Oops, is that right? I don't want the delta risk, but I do want the gamma risk, right? Because I think that the volatility of the stock is much higher, and that I could definitely make up this theta number, and that then, which is fine, right? If that's what your model is telling you to do, and it's a good, obviously that's a very popular strategy.
Yeah.
And that, but at least all your risks and how much gamma and how much theta you have and how much Vega risk you have. And as long as you're working within the parameters of what's acceptable risk to you, then you should be fine.
Now, how do you get?
Does that make
How do
sense?
you? Yeah. How do you look at what are acceptable parameters for your risk? How do you personally look at that? Or do you have any tips for anybody just getting in and them beginning to create ideas of how to quantify that risk?
Yeah, I don't know if there's like a rule to that. You kind of, if you're starting out, if you want,
Yep.
you want to experiment with this is the lowest amount of risk you can,
Sure.
until you feel comfortable with it, and until it's different for everybody. Um, so that's
Is
tough.
it all
That's
just
a tough
gut
answer.
though? No, right?
It's
The professional traders are looking at it as they put a number, right? Right, rather than
they
just a gut feeling on, ooh, this is a little too risky for me.
uh, I can't speak for a lot of traders, but when if you're if you're making money,
Yep.
and you could do the same thing at the same prices, you're going to increase your risk.
Yep.
If you're losing money, you're going to start decreasing, right? That's kind of your biggest signal. Well, if I'm losing, I shouldn't be doing it. Right? If I'm if it's making me money, if these are definitely
If it's making
underpriced,
money,
I
keep
should
doing
do.
it. If I'm losing money, stop doing it. It's very simple math, Dmitry.
It's exactly. It's almost. It's not even the math problem. It's more of like a logical problem. Don't. If you're losing money, stop doing it because it's not working. But if you're buying options and you're like, hey, my decay is 900,
Yep.
but I'm making $3,000 a day, and the implied volatility is not. It's at the same spot. I could buy more with my prop. Then maybe that's what you do and your expectations haven't changed. Then you would want to do more,
Yep.
right? If it's a good trade. If it's not a good trade, there's no reason to, be in it.
Yeah.
So maybe that's the only way, I could kind of describe
So it's
the,
always be making money, man. That's the key. It's just easy as that, man. Make sure you're
yeah,
making money.
yeah. The idea is to, right, exactly. The idea is not, you just want to do something that's making money. You want to find a way to make money. And that's really your job as a trader. It's not about making the right calls or it's not about being right. It's just about, did you figure out a way to make money?
Yeah, I think that's hard for the beginning trader to understand because they want to be right, or they think
Yeah.
they are right, or they know better. And learning
It,
that is not the way to trade.
right.
That's hard
Yeah.
lessons learned. Hard lessons learned.
It's hard lessons learned.
Yep.
Exactly. Yeah, because that's how we all start, right?
Yep.
We all start because we want to be right, and not only do we want to be right, we want to also give reinforcement from other people who think the same way, and, and then
I
we
think
all
you've
do
just
this.
described our entire world right now.
Yeah, yeah. It doesn't
It
work
does
in
carry
trade,
over into real life, doesn't it?
huh?
It
It
carries
it
over into real life.
it carries over to real life.
Absolutely.
In trading, it doesn't work, right? So
It doesn't
so
work. Actually, trading is a nice way if you can pull that into your real life. It's not a bad thing to do. But yes,
yeah.
absolutely, you learn in trading very quickly that is not the right way to approach trading. right?
No, it's funny. I was watching, I was trying to watch YouTube videos and just kind of learn how other people are teaching, so I could just like pick up, techniques of
Yep.
like how do I use a slider? And I started getting commercials from YouTube. And one of the guy, I didn't go to the website, but one of the things he said, which what was true, is he said that if if you want to be the 1%, if you want to make money like the 1%,
Yeah.
the first thing you have to do is stop doing what the other 99% are doing.
Words of wisdom right there, man.
Yeah,
Words of wisdom.
Yeah, yeah. I didn't even see what he was saying, but that
Who knows
that
what
he
he's
hit it on.
selling, but
Yeah, he know. Yeah, I don't know I don't even know what he was selling, but he hit that on the nose.
yep.
Um, so so yeah, that's and when you say like what is the right amount, I don't know if you could really say for sure what is the right amount,
Yeah, it's different for
every
everybody,
time.
right?
Yeah, it's different for everybody, but you obviously, if you have a position on that is causing you stress, or you're watching it, you have too much on.
Yeah,
Right?
especially. I mean, that's the
You're gonna
thing.
know.
Like, people are used to trading. Like, everybody starts by trading stocks and stuff, and you know, watching the stock. How's the market doing today? How's it doing today? How's it doing today? Um, where you really need to change from that mindset. You've got to change if you want to do this. If you want to
Yeah,
trade if you want to trade in this way, this is not
yeah,
buying a stock and holding it and praying, right? This is something very
no,
different.
yeah, exactly. It's very different. You don't want to be sitting in front of and you see this sometimes where people are watching the stock ticking and they're like, oh my God, your position is too big.
Yeah,
You have to reduce your position. You shouldn't be in that situation,
right.
unless you have to feel really strongly about it that you shouldn't even be saying, oh my God. You have to feel so strong about it that even if you lose, you're going to be okay with it, because
Exactly.
you're like, I don't care. I just, you know, that it was a good bet, and if I lose, I lose. But
Exactly. Yep. So bet small, small, small if that's what you need to do to start, so you feel 100% comfortable.
yeah, you bet small, small, small. Just think of it like it's a business, right? If you're trading, it's almost like a business, and if you're doing it, it's laws of large numbers. It's what insurance companies are doing. It's what casinos are doing. It's in statistics. That's how it works.
Yep.
And you have to make lots of good trades,
Good, smart, small
good
trades.
strong, right, with positive edge, with where you tilt the odds in your favor.
Why don't you stop sharing your screen there, Dmitry? Bring your face back up. That's absolutely right, guys. If you remember the last training session where Dmitry was talking about it looking like a casino, where, right, you want to be the casino, right? You don't want to be the guys on the other side. You want to be the casino where lots of people are on the other side are making thousands of small bets. That's when you can really win, when you get that small edge on your side. So good stuff today, Dmitry, breaking down. I think this is going to be like a 20-part series, man, to get to the final trading model where people will have a literal model sitting in their computer, man. We're getting the base. You can't build a house without a solid foundation. We're building a solid base right here, Dmitry.
Yeah, you have to know all the components. You have to know all the parts, how they work, or none of it will make sense.
That none
I
of
wish I could tell somebody, hey, here's like
Exactly, man.
there's three things you do and that's it.
Exactly.
It doesn't work
I was
that way.
saying, I think I was listening to a guy today. He's like, look, man, what other thing on earth do you think you could listen to a YouTube video or read a book on brain surgery and then tomorrow wake up and do brain surgery? Do you think that would go very well? Your chance of success would be zero. The
Yeah,
thing about the market is, because trades move 50-50 or up and down, you don't either way, it's a somewhat of a random event.
yeah,
You can actually have success, right? So you can actually do successful brain surgery, maybe for months, maybe for years, but
yeah,
there will come a day, if you have not learned the basics of this, where you're going to get slaughtered. And so
yeah,
you got to
yeah.
learn the basics, man. You got to learn it,
Definitely,
right?
definitely.
So
Yeah.
everybody remember that. Keep that in your pocket. We're learning the base right now, and we're going to build on this. This is awesome. I love it.
Yep.
Remember, click that subscribe button if you're on YouTube. If you're on the Chameleon, click over at the side and sign up for the free trial. We give 7 days free of the Chameleon where you can try all of these premium features that we talk about every day. And good stuff, Dmitry. Thanks so much.
All right. Thanks, Adam.
All right.
Thanks,
have a great
guys.
weekend,
Thanks for all
everybody.
the
And we will
emails.
see you Monday morning. Talk to you later.
Bye, guys.